Hello everyone, welcome to Bald Guy Money. I am Bald Guy, and we have fresh data that came out just this weekend on loan delinquencies, which shows the number of people who are not paying their debts back to lenders. And maybe the most shocking detail in all the reports I looked at is that credit card delinquencies rose yet again at the end of 2023 and are now touching levels last seen at the end of 2011. Now, you may be sitting there asking yourself, okay, so what? Is this even important? But in this video, I am going to present to you all multiple data points that show you all exactly why this is a very bad thing. I will also explain why things are getting bad and what I think the likely outcome of all of this is going to be. Now, before we get into it, if you're in the United States and want to protect the value of your money with real gold and silver, please check out channel partner Pimbex. With the value of fiat currencies eroding at the fastest pace in decades, Pimbex has everything you need to protect the value of your hard-earned dollars, including these quarter-ounce maple leaf coins for around $560 a piece, which is a great way to get a little gold in your portfolio. I'll leave the link to this deal in the video description below. And for those of you interested in gold or silver IRAs, give them a call at the number on the screen for a free consultation. Just please remember to let them know you came from the Bald Guy Money channel. So, as I've already shown you, credit card delinquencies are at levels not seen since 2011, and the total balance owed by all Americans on their credit cards has now surpassed $1.1 trillion, as you can see on the chart here. And it's alarming because we have never really seen such a steep nominal increase in credit card balances as we've seen over the last 2 years, with people borrowing more and more just to keep up with the rising prices of goods and services. In fact, the problem is much worse than just the pure size of the debt and rising delinquency rates that we're seeing. And that's because nearly half of Americans were unable to fully pay off their credit card at some point in 2022, according to the data shown here. A problem which I can't help but assume has gotten worse in 2023 and early 2024. And with interest rates on credit cards well above 20%, you can see the annual rates for different types of cards right here on the screen. That means the hole that many Americans are sitting in is getting deeper and deeper as prices continue to go up and real wages stay more or less the same. Now, for some of you who are buying into the strong U.S. economy narrative being pushed by politicians and the mainstream media, this is where things get really interesting. And this is a bit of analysis you probably won't find anywhere else, and why I think everyone should subscribe to my channel, and that is the relationship between the unemployment rate and current debt delinquency levels. So let me explain a little bit about this. I said delinquencies on credit cards, so people simply not paying their credit card debt back, hasn't been this high since the end of 2011. You saw that on the chart at the start of the video. Now, the delinquency levels in 2011 can easily be explained as a consequence of the global financial crisis, which caused a major economic downturn worldwide and resulted in a U.S. unemployment rate of 8.6% in November of 2011. So obviously, with so many people out of work, you can easily understand why they were not able to pay back their credit cards. But in 2024, official unemployment in the United States is a minuscule 3.7%, at least according to the official numbers. And with job openings in the USA disappearing faster than the American dream itself, as U.S. manufacturing continues to struggle and major corporations cut many higher-paying jobs, you have to ask yourself the question, what is going to happen to debt repayment as the job market continues to deteriorate? Because from my point of view, this situation is going to get much worse before it gets better. Because as I've said in the past, credit card defaults are usually the first in line when it comes to debt defaults. Of course they are, because if you have to choose between paying the bill for Christmas presents versus paying for your home, you're obviously going to pay for your home first in line. But despite the fact that single-family home delinquencies remain low, property foreclosures as a whole are on the rise, and you can see that in the data shown in the chart on the screen. In fact, if we zoom in a bit on bankruptcy filings, 3 of the 4 most common forms of bankruptcy are on the rise, including individual and business bankruptcies, with food producer bankruptcies being the only ones remaining at lower levels as food prices remain high. So for all of you who are convinced that a soft landing is on the way and that everything is going to be okay, remember that has only happened in 3 of the last 13 interest rate hiking cycles. And what we should be expecting is more defaults on debt driven by business failures and higher unemployment rates, which will eventually force the Federal Reserve to inject more cash into the system to prop up banks that are already severely underwater on their US bond holdings. That's going to cause more inflation, it's going to cause more hardship, the further devaluation of cash savings, all of this likely coinciding with a massive stock market correction while people flee to safe havens like precious metals, which have historically done very well during recessions. Now, with that said, I want to move on to this video's viewer question. And just as a reminder, you can submit your questions in the comments section of all of my videos, even old videos. I read all the comments I get, and your question just may be the next one to appear in a Bald Guy Money video. And this week's question comes from a longtime viewer, Eli, and I want to say a special hello to Eli because he has been watching and commenting on my videos for a long time now. So thank you very much for your question, Eli. And Eli wants to know, if you had enough money to buy a 1/10 of an ounce gold eagle, would you buy that today or a 2024 silver eagles, he's asking. And that's a great question. I know many people grapple with that dilemma, and I want to cover this question in 2 parts. The first part is, I think having gold is key to having a proper stack of metals that delivers the insurance protection against devaluing fiat currencies and an unstable financial system built on paper and promises. And I also think that if you're looking for smaller fractional gold, if you're a stacker on a budget, well, I've got some with me right now. I'd urge you all to save up for a 1/4 of an ounce gold coin. And you can see here some of the great offers from channel partner Pimbex, some of the offers that they have on their site right now. Because saving up for this weight gets the premium you pay above the spot price down to a more reasonable level versus buying a 1/10 of an ounce gold coin. And it also stores some serious value in a very compact form. Now, would I buy this over an American Silver Eagle right now? And you can all see that I have an American Silver Eagle with me. This is a great coin, a fantastic coin that I love to stack when the premiums are low. And what I want to say is that it all depends on how much silver you have versus gold. For example, and this is what applies to me. This is how I look at it. If my ratio of silver to gold is above 40-1, then yes, I would choose to buy gold over silver. Remember, the silver to gold ratio is growing for a reason, and that's because central bank demand is driving the price of gold up. That, paired with the demand coming from regular Chinese citizens, we have seen a higher floor put in on the price of gold, which is a topic I touched on in my last video. So the gold offers you much more stability, or maybe I should say less volatility, which is important, especially for people who are already retired. Now, since I'm a bit younger and I have a lot of gold already, I might be more inclined to stack silver eagles, not only because of how low the price for silver is right now, but also because of how much premiums have come down since 2022, and you can see what they're going for today at Pimbex.com. So, Eli, I hope that answer gives you enough food for thought to make the best decision for yourself. And I thank you very much for your question and for being a great and loyal viewer to Bald Guy Money. Thank you so much, Eli. Just before I finish, I want to ask you all to please remember that you can get more Bald Guy content on Patreon for relatively cheap. It's only $9.99 a month. You can cancel at any time. And if you get a whole year subscription, the price is actually lower than $9.99 a month. And I just released a video on Patreon talking about the stock market rally, what it's built on, and why I think it won't last. So if you're interested in supporting what I am doing here and getting some additional cool content, I will leave the link to join in the description and pinned comment below. With that said, that's it for this video, everyone. I'm thanking you all for watching. Please, if you like the content, take a second right now to leave a like. It's totally free to do that, and it helps this content reach more people. And until the next time we see each other, everyone, please take care of yourselves and take care of each other. Goodbye.